Despite the presence of some significant turnaround catalysts, the so-called Cathie Wood stocks are due for another, even more, a substantial reversal in 2022. Because while stocks do not go up indefinitely, they also do not go down indefinitely, and Cathie Wood stocks have fallen too far, too fast to oversold and undervalued levels. Why does the possible stock double in 2022 could be a trap? You don't want to miss this. Are you new to this channel? Subscribe and hit that notification bell to help us produce more wealth-building content. You can count on Dinero Association to keep you up to date on the latest financial and economic developments. Cathie Wood affirms that we are about to fall into this trap. We have hit a new low. If you think Cathie Wood is more comfortable in her direct investments when 2022 hits, you may be wrong. Did you know that the price of ARKK dropped 19% in January alone, while assets under management dropped 24%? ARKK has lost 50% of its value in the year from its all-time high in early 2021, while asset under management has lost 55%. This means that for ARKK to return to its all-time high, shares would have to double or increase by 100%, indicating the massive capital destruction in recent years. What is Cathie Wood's contingent plan? In this video, we will attempt to understand why Cathie thinks that we are hitting rock bottom because of this mystery trap. Let's begin with massive inflows in exchange-traded funds. Inflows into ETFs hit a new high of $1 trillion in 2021. That's a significant sum, but the fact that the inflows have been so large may be a self-fulfilling prophecy. The S&P 500 is merely a collection of equities that Vanguard closely monitors to construct an ETF. Money flowing into the S&P 500 inflates the valuations of the companies within it over time, generating returns on its own. In essence, one of the reasons why fund managers struggle to outperform the S&P is because rising inflows are inflating it. This is like ARK Invest, that if investors sell the ARK ETF, its stocks will also sell off. This is evident in ARK's assets under management, which has fallen from $22 billion in November to only $16 billion today. That is a significant sum of loss and headache to investors. Stock valuations continue to be unstable. Several aspects go into valuations, but valuations are at all-time highs regardless of how they are calculated. Those who follow the stock market are undoubtedly familiar with the Buffett indicator. The Buffett indicator is a ratio that divides the overall market value of the United States stock market by the annualized GDP of the United States. The current ratio is 21%, which is much higher than the national average. Why is the Buffett indicator the preferred method to assess how expensive or cheap the aggregate stock market is at a given point in time? The Buffett indication would still be regarded as expensive even compared to the long-term trend line displayed on the screen. The Buffett indicator is above 2 standard deviations over the trend line. This suggests that we are only at these valuations 2% of the time in this data set. Some may attribute these equities prices to inflation, but a closer examination reveals that the association is neither positive nor negative. Inflation peaked in the late 1970s and early 1980s, reaching over 10% at one point. For obvious reasons, this period is known as the Great Inflation. The Buffett indicator was at all-time lows at the time. Cathie Wood's declaration that index funds are in a bubble may seem peculiar, especially because she is often regarded as the poster child for the modern IT bubble. Her thesis makes sense though, considering how many investors and fund managers mindlessly invest in the S&P for a guaranteed 10% yearly return over time, as she puts it. Cathie believes the S&P will be perceived as considerably riskier than previously thought, particularly if companies in the index are disrupted. Instant coffee hasn't done much in decades when it comes to innovation. Hey, take a breather there for a moment. If you have not yet subscribed, please click the subscribe button to ensure that you don't miss any of our videos. Inflation is another factor that hurts the financial market. Even though retail has increased dramatically since the outbreak, institutional investors continue to significantly influence the bulk of companies. Most institutional investors are currently concerned about the Federal Reserve's actions and liquidity being trapped in illiquid stocks. That's why so many rushing into big tech. They can see the win, but they fear illiquidity. Individuals should seize this fantastic chance. We don't need to compete for vast sums of money to reinvest in the hottest digital businesses. With all the unintended and intentional supply chain interruptions, and let's be honest, companies price testing consumers who have been saving for the last year, a particularly cold or lengthy winter may be financially disastrous for millions of people. There are several apparent problems. Most homes are insufficiently insulated and lose heat. They lack wood stoves. They lack grid-independent backup generators, and they do not provide occupants with a means of living independent of foreign fossil fuel companies. That is precisely the point. If the bad weather continues and the cost of heating rise 100-fold, millions of people will be forced into bankruptcy, effectively halting the stock market. Cathie Wood's deflationary claim contradicts strong inflation. According to Cathie Wood, deflation will be the economy's next primary concern. However, inflation is at a multi-decade high. Not having commodities exposure like oil and mining stocks protects her savings from rising inflation. As a result, she leaves her clients exposed to a climate of escalating inflation. A rise in inflation will drive the Fed to boost rates further. More effective interest rates mean higher stock discount rates, because future profits are years away. This proportionately impacts pricey growth stocks. To protect against rising interest rates, ARK invests in companies that are barely profitable or non-profitable. Equities, particularly ARK's costly growth corporations, may face further pressure in the future as rates rise. ARK, like the other ARK funds, faces new obstacles. This allowed ARK to boost its exposure to its chosen stocks. Thus, companies like Tesla and Teladoc saw their stock prices grow, increasing the ARK fund's net asset value. However, it only works until it doesn't. As assets under management ceased expanding, ARK Invest went from a net buyer to a net seller. This affects the share prices of ARK's preferred holdings, lowering their net asset value. This causes further outflows, forced sales, and so forth. The previously virtuous cycle of rising prices leading to more price increases has become a vicious circle with dropping prices. What do you think about this video? Type your comments below. We are Dinero Association, your partner in building wealth.